This salad restaurant IPO'd at $5 billion, reaching over 200 locations just 15 years after being founded by a 22-year-old college student. The craziest part is that they've never made a profit, losing $100 million last year alone. Yet they're still seeing massive success. That's why in this video, we're going to cover the story of Sweetgreen and the 7 lessons we can learn from the 22-year-old founder, Jonathan Neiman, to succeed in the highly competitive restaurant industry using these unusual moves. I'll also give you the secrets he used to raise $600 million from investors before his IPO and how he expanded to so many locations so fast that you can use as well. So let's dive right into it. First, it's important to understand how Sweetgreen was founded differently than most other restaurants, because the way that Jonathan designed his brand set him up for massive scale from the beginning. That's lesson number 1. Building as a tech company first, not a restaurant company. You may be thinking to yourself, Adam, I don't want to start a tech company, I want to start a restaurant company. And it can sound confusing to start thinking like a tech company from the beginning. So if that's confusing to you, stay tuned. I'm going to break down exactly what it means and how it changed his strategy and how you can change your strategy in building your restaurant business as well using these lessons from Sweetgreen. And even if you don't want to build a tech company, there's key secrets that you can learn to attract investors and attract talent that you're going to hear in these 7 tips based on Sweetgreen's success that you can apply even without this mindset. The story starts back when Jonathan was in college at Georgetown in Washington, D.C. He was really excited by the world of tech companies because companies like Facebook and YouTube were just starting to blow up. In being fascinated by that tech world, he realized something interesting, and that is that tech companies are built for where the future is going, not for where the present is today. When Zuckerberg started Facebook, there was no market for social media. Yet he saw a future where everyone used the Facebook app and created that future by building it. So Jonathan asked himself a similar question. Where is the future going, and how do I build a business that is positioned to win in that future? That's part of the way that he came up with the winning idea that was Sweetgreen. The best tech companies seem to have one more thing in common, which is actually lesson 2 to Sweetgreen's success: solving a problem you have personally. Because when you have a problem personally, you can be sure that a lot of other people do too, and that a real solution that solves that problem will be a part of the future. So you may be wondering, what was his problem exactly? It was that he felt frustrated that no restaurant offered healthy food with convenience and an affordable price. That's how he came up with the idea for Sweetgreen, a salad concept which offered convenient, healthy food at an affordable price, because he faced the problem firsthand and recognized a clear need in the market. He had good instincts about the best way to solve it that were informed by that personal experience. Too often, I see entrepreneurs start restaurants because they think that there's a huge business opportunity when they've never experienced the problem it solves personally. It would be like if I looked around town and thought to myself, there are no bubble tea places, and bubble tea places have great margins and low food costs and require little upfront capital, so I should open a bubble tea place. That's starting with a potential business opportunity versus a problem that I faced personally. I don't personally drink bubble tea. I don't think there's a problem personally that my town doesn't have bubble tea places, so it probably wouldn't be helpful to people if I opened one, even if it looked good on paper in terms of the business opportunity. Whereas Jonathan solved a problem that he had firsthand. Convenient, affordable access to fresh, healthy foods is what he built his business around. That's how he knew there would be demand for it and what the customer wanted. He was that customer, and he was building like a tech company. In fact, you're going to see in number 7 how he used this even more advantageously to build a huge business that attracts a lot of top quality talent. But before we get there, it's worth discussing the differences between a tech company and a traditional company. The big difference between tech companies and traditional companies is that tech companies build for the future, not for the present. Meaning that when Jonathan started in 2007, there were almost no healthy takeout restaurants. Salad restaurants weren't really a thing. Almost all restaurants were instead built around the in-store dining experience, with the exception of pizza restaurants, Thai restaurants, and Chinese restaurants. Yet that didn't stop him from creating his unique salad concept, because he asked himself, what is the future going to look like, and how can I build a business around that? He saw a future where more and more of the restaurant industry would be off-premise focused. So he built his concept around where he saw the world going, and it worked. because as the industry shifted to being takeout heavy over the next 15 years, his entire concept was built around that, so he benefited from that shift. He even made a bold move at his first location, which ended up serving him well, selecting a very small space for his store at just 500 square feet with no dining room. That's actually the next lesson. Lesson number 3, selecting a strategically small space. Before I get into why this was such a key to Sweetgreen's success and why you should do it as well, if you've been enjoying learning about how to build a successful restaurant on this channel and you want to continue getting the latest strategies that are working today for doing that, then tap that subscribe button down below, because every week I post new videos detailing what I've learned in helping thousands of restaurants grow for free on this channel that you'll get if you're subscribed. Anyway, back to what was so brilliant about Jonathan selecting that small space. He selected the tiny 500 square foot space at the time because it aligned with where he saw the future going. A huge increase in takeout orders with the rise of online ordering. But it ended up having another major benefit for him: instant social proof. Because the truth is that when people pass by restaurants and they look full, they see that as a sign that it's very popular and worth trying. Man, that place must be good. Look at the line that they always have. And it's much easier to look constantly full when you have a tiny space and no dining room. People see that line and they think to themselves, man, that place looks popular, I gotta try it. Not, wow, that place is only full because they have a 500 square foot space. That is not the thought that comes to their mind. And interestingly, in 3 out of the 3 best restaurant IPOs from the past 5 years, they've all followed this pattern in that first location. Think about your own experience. When you're walking down the street and you see a street performer with a huge crowd around them, you immediately lean in and want to know what's going on. Whereas when you see that lone musician on the street that's kind of just playing to themselves, there's no urge at all to stop and see what's going on. The same is true for your restaurant. And in restaurants, it's literally cheaper to get that huge crowd by just selecting a smaller space. So it's even easier to make a profit, marketing benefit aside. When Danny Meyer started Shake Shack, he was already a multi-millionaire and owned 10 restaurants and could have afforded a huge, glamorous space for that first Shake Shack. Yet he intentionally chose a 500 square foot space, just like Sweetgreen, because he knew that always looking full and always having a line out the door would be the best marketing that he could set himself up with. And it worked. There's another brilliant thing about the economics of selecting a smaller space and designing without a dining room like that first Sweetgreen location, which is that more of your space can be dedicated to the kitchen and you don't get bottlenecked by how many people you can have seated at any given point. That means that because you have a smaller kitchen and because everybody's consuming your food outside of the restaurant anyway, that you can do a lot more in revenue and food output through the smaller resources you have. So not only is it easier to be profitable, and not only do you encourage a type of customer that ends up ordering more takeout orders, but you also are running a much more efficient use of that real estate since it's all dedicated to making food and not to the very space intensive thing of people sitting down and consuming your food in your restaurant. It also set them both up nicely for where the future was going, being mostly about pickup and delivery. There's one more key thing that Jonathan's been doing from the start, which then set him up to be such a success with investors, which is lesson number 4, investing aggressively in new technology. Jonathan didn't just take the mindset of a tech company in building for the future at Sweetgreen. He also invested like one, aggressively in new tech to be prepared for that future from the very start of his business. This meant having their own website with online ordering from the start in 2007, when that was super rare. They invested heavily not just in web design, but in search engine optimization and other forms of digital marketing, which were just emerging and helped them acquire customers really effectively. That website and SEO in turn helped them make more money on all of the early adopters of the internet who wanted to find restaurants to order from online. It also meant that they were able to figure out how to do this new online ordering thing very well before most restaurants even had it going for them, which is what led to them launching their own app in 2015. Way before most major restaurant corporations had one. Why? Because they knew what an app would do for them. Make it 10 times easier for regulars to reorder. Instead of needing to find a website every time they wanted to order, they could just open an app and go. This is why 50 out of the 50 most valuable restaurant corporations in the United States have their own branded app at this point. It's also why I've spent the past 6 years building Owner.com, which gives independent restaurant owners their own integrated integrated branded mobile app, their own SEO, their own website that has all of these customer attracting benefits so that they can get the same benefits as major corporations like Sweetgreen spend millions of dollars to achieve without having to spend millions of dollars themselves to achieve them. Having their own app and using new tech wasn't just an asset for Sweetgreen to improve the ordering experience for regulars. It also helped them raise money from tech investors. That's lesson 5, raising capital like a tech company. The combo of identifying as a tech company, investing in new technology, and skating to where the future was going made them appealing to tech investors in the way that other restaurants aren't. And they took advantage of that by aggressively raising money from the start. From that year that they opened in 2007, raising their seed round, to the year they IPO'd in 2022, they raised $600 million before going public. When tech investors were interviewed about why they invested in a restaurant, Sweetgreen, they said it's because it's a great tech business that just looks like a restaurant business. You'll notice that Domino's has been saying the same thing for the past 10 years. And Domino's outperforms most of the high growth tech stocks like Microsoft and Facebook for this reason. This is a huge advantage because most restaurants need to rely on bank loans for expansion or private individual investors. But Sweetgreen was able to attract tech investors because they've been operating like a tech company from the start. So you're probably wondering to yourself, Adam, why should I care about all the details of raising from private tech investors? Because if you're expanding a restaurant, it's very difficult to do on just profits alone. It typically takes 3 years of profits from a single restaurant location saved up to be able to open that second location, and then another 3 years for that third location, and then another 3 years for that fourth location. Whereas raising money from private investors enables you to invest ahead without having to wait decades to reach that 10th location in the way that expanding purely from profits would force you to. As you study the success stories of the most successful restaurants founded in the past 20 years, whether it's Sweetgreen or Kava or Shake Shack, they all raised money from private investors or institutional investors through having a differentiated story to tell them about their growth. By raising from the private markets, they were able to expand each of them to hundreds of locations in less than 20 years, which is unheard of through just profits alone. And now you might be thinking, Adam, what about taking out bank loans? Can't that be a way to fund growth? Yes, it can, but as you know, if you've ever applied for one of these loans, they almost always make you collateralize your house personally and personally guarantee the loans that you're taking out for a business. Whereas raising money from private investors like tech investors or private equity groups enables you to raise in a more aligned way that isn't devastating to you personally if the business doesn't end up working out, but that enables them to share in the upside of what you're building. Having a really ambitious goal is part of being an entrepreneur, and it shouldn't require having to risk your house or personal bankruptcy in the case that it doesn't work out. By the way, if you want me to take a look at your restaurant concept today and give you thoughts on how to make it more appealing to investors, then feel free to comment your restaurant name and the city it's in down below. I read all my comments and reply to them, and I'd be happy to help by taking a look and sharing with you some thoughts and feedback based on what I've seen work best for the restaurants that do go down this route of raising private financing. And even if you don't want investors, I'll still reach out and give you some good feedback if you share your restaurant name and the city it's in a comment down below. They made another key move, which especially helped them raise from investors, and that is lesson number 6, protecting direct customer relationships. Part of the reason investors value their company so much, even though they're not profitable, is they have millions of direct customer relationships. They aren't dependent on the delivery apps, which take the customer relationship away from the restaurant and then charge them a ridiculous 30% tax on every order, which isn't sustainable to the restaurant. Instead, what Jonathan's done at Sweetgreen is create a system where most of their customers use their own app, the Sweetgreen app, to order. And they've designed a whole system around protecting direct customer relationships. Everything from their packaging to the posters in their dining room to the way they train their staff is designed to push people to order directly from them online, whether that's through their app or through their website, because they know that the most valuable asset in every business is its customer relationships and customer data. In an industry where restaurant owners owners are losing that advantage to the delivery apps, Sweetgreen continues to differentiate by having tens of millions of people with their app installed, with their marketing opt-in, that they can show to investors and that they can use as a company to drive additional revenue from their existing customer base. Their customers aren't being held hostage by the third-party delivery apps that then charge them a ridiculous 30% ransom on every transaction. That doesn't make for a very investable business. Instead, they have complete access to their customers. They can send them text messages or push notifications at any time with menu updates. They don't have to pay 30% on every transaction like through the delivery apps, because those customers are ordering directly from them. And they use those customer relationships to implement lesson 7, which has been maybe the biggest key to their success. Having a clear mission that is communicated to customers and sticking to it. From the beginning, Sweetgreen defined a mission that they knew would inspire customers and employees. They describe it as building healthier communities by connecting people to real local food. And they stood by this mission even when it's been inconvenient or costly for them, so people know they take it seriously. If you listen to their earnings calls today, they're constantly being attacked by public market investors, saying how costly it is to buy from local farmers. Why not just go to national distributors like Cisco? And Jonathan always responds by saying, because it's our mission to serve this local food. And the investors have nothing to say. This is how they're able to attract such great talent and such loyal customers who are willing to order directly from them. They've defined this mission that they know is hard, that they know is costly, and they stick to it. It's echoed in every part of their story, from how their restaurants' dining rooms are designed, to the messaging they send out in their email campaigns, this idea of connecting people with real food. And that's what inspires their customers to be so loyal, and inspires their team to love them so much, and inspires investors to continue funding them, because they're creating a change that people want to see in the world, and they view Sweetgreen as the vehicle for driving that change themselves, by being a part of it. Speaking of attracting loyal customers, Danny Meyer from Shake Shack is the master of that. And I actually just posted a video breaking down the key lessons from his journey, how he was able to build that brand to billions in less than 20 years, just like Sweetgreen. But there's unique lessons to learn from his journey. So if you want to see that video, I put it to the right of me right now. Click on that video and take a look at the secrets behind Danny Meyer's and Shake Shack's success. That's all for this video. I now need to go enjoy some of Jonathan's creation myself. I had to order it as we were talking about the power of his app. It is incredible. So I will see you all later, hopefully around this channel, if you click that subscribe button. Take care.